Can you, first of all, give me some details about what you mean by companies in transition?
Well, look, for example, what's happening with Twitter. For example, the transition that they're in right now, we don't really know exactly what that's going to look like. But clearly, there's going to be a change in their business model. Look at a company like Meta, who was Facebook or is Facebook, but now is moving towards this sort of virtual thing. So I think companies like, say, a Netflix, that you're uncertain what this new rate plan is going to look like. I think that you're going to see challenges for companies where investors don't have more certainty about what their business plan is and what their profitability will be. I think cash flow is really going to matter, especially if we go into a recession.
Do you think that what we've seen, say, for instance, on the jobs front, with more jobs added than expected, the unemployment rate rising a bit, I know we're looking forward next week to consumer price index and what sentiment looks like moving forward.
Right.
Do you think any of that matters to your thesis about opportunities in technology?
No, I don't, because I think if you're buying technology, depending on which technology you buy, you're basically in it for the long term, and you're getting really an opportunity that has not been available to investors in quite some time based on the market rally. So I think that what's happening with the jobs report was kind of I guess it was kind of good news in terms of the unemployment rate clicking up a little bit. That'll certainly, here in Silicon Valley, you're seeing lots and lots of layoffs right now. But, everything is really going to come down to whether or not we go into a recession next year, which I think we will. And in that case, you want to be in companies that are pretty strong and pretty balance sheet friendly.
Including from Amazon. We just heard that concerning its corporate workforce. But you say Amazon is one of the companies, along with Disney and Apple, you think that investors should consider buying. Why?
Well, investors should look out on their doorstep right now and see if there's a package. I mean, that's how much people use Amazon. It's sort of a regular weekly visit for people oftentimes. A company like Disney is not getting, I think, the credit they deserve for what's happening in theme parks. They're constantly sold out. Yes, I know they have challenges at ESPN, but I think they'll resolve those challenges. And then Apple is just a cash flow machine. There's a reason why it's Warren Buffett's largest position. We're a believer in that position, and we think they're going to continue to grow the services space.
And I think, hey, Michael, it's Brian. There's something important here, I think, from just a macro lesson perspective that maybe you could help our audience out. We got a lot of viewers and investors that have only been in the markets last couple of years. They've mostly only known good times. They hear recession. Right. It sounds scary. But history also says that sometimes recessions can be the best time to buy stocks for the long term.
Yeah, in fact, if you think about what's happening right now, Brian, I think the market is down because people think there is a recession now or will be in the near future. So I think that when you have down opportunities in the market and a recession or expectation of recession certainly does that, I think it's a great opportunity for investors to cherry pick and be selective, go slow, don't put everything in portfolios in one day, but I think it's time to sort of drip into these sort of names as long as you're a long-term investor.
Michael Yoshikami, real pleasure. Thank you. Good long-term macro lessons.
Shepard Smith here. Thanks for watching CNBC on YouTube.